Hi students, welcome to Sunil's tutorial. My name is Sunil Mirwani and today we will be doing this chapter called as capital budgeting. Guys, I am doing question number 1, page 281. Okay. Now before I start with the sum, I will show you some formula on the right hand side of the page. Right? Now, first formula. Savings minus additional cost is equal to cash inflow. Second, payback period is nothing but original investment upon cash inflow. Right? Initially, let's just start with these two formulas. Then, as we proceed with the chapter, we'll build on this. Now, let's see this. They've given you that Mimosa company has invested in a machinery costing 9 lakhs. Following details are obtained. Now, let us see where all do we have savings in this. Savings. Retrenchment of staff. Retrenchment means removing staff. If I remove staff, I don't have to pay them salary. So that is a saving for me. So you have retrenchment of staff. You have 4 staffs, each of whom is being paid a salary of 20,000. So I will save 80,000 in terms of salary. Then savings in wastage is 40,000. Savings in wastage, yes, is 40,000. Then savings in maintenance. Savings in maintenance is given to you as 10,000. So my total savings is going to be 1,30,000. Right? Now let us see what is the additional cost. The additional cost. 1. Staff. You have to employ a new staff who is going to be paid a salary of 40,000 rupees. Next, electricity bills. Your electricity bill is going to be 15,000. So your net additional expenditure is going to be 55,000. Right? Once you have this, then you can find out your cash inflow. Cash inflow is nothing but A minus B. 1,30,000 minus 55,000. I presume that is 75,000. Right? Once you have this, then you can find out your payback period. Payback period is given by the formula original investment upon cash inflow. Right? Original investment, I will be buying the machinery for 9 lakh rupees and my cash inflow is 75,000. Right? So it should take me approximately 12 years. Right? 9 lakhs divided by 75,000, 12 years. That means to recover the cost of this machinery, it will take me 12 years. If I am a true businessman, I would never buy this machinery because the payback period is very high. That is how you take a decision whether a particular machinery is to be purchased or not to be purchased. Fine, do we get this thing clear? Do we understand this? Let's move on to another sum, guys. Now before we move on to the next sum, I will give you a couple of more formulas. Right? I'll give you a couple of more formulas. Depreciation is cost minus scrap value of the asset upon estimated life. Right? If tax percentage is given in the sum, if tax percentage is given in the sum, then savings minus additional cost minus depreciation will give me PBT. PBT stands for profit before tax. Less tax will give me PAT, profit after tax, right? Add depreciation will give me cash inflow. So this is another method to calculate cash inflow, depending if the tax rate is given to you in the sum or not. If the tax rate is given, then this is how you will find out cash inflow, right? Next, payback profitability. Payback profitability is given by the formula cash inflow into estimated life minus payback period plus scrap value. That's how you get your payback profitability. Let us see a sum based on this. Guys, just go through this formula. Okay, let's start with the sum, guys. I'm doing question number 4. Question number 4, page 282. Right? Let's see this. They've given you 3 machineries and they've told you which machinery should be purchased. Okay, let's start with this first. Let's find out the depreciation. Depreciation for machinery A, B and C, right? Now the cost of the machinery is given to you as 17,500. Scrap value is given to you as nil. I'm very sure some of you will say, sir, there's a scrap given in the sum. That is scrap of material. If there's a scrap value of machinery, it will be specifically mentioned that it is scrap value of machinery divided by 10. For machinery B, the cost of the machinery is 12,500 minus nil upon life of the machinery is 6 years. For machinery C, the cost of the machinery is 9,000 minus nil upon estimated life is 5 years. So for machinery A, depreciation is 1750. For machinery B, the depreciation is 2083. And for machinery C, the depreciation is 1800. So the first thing that you do is to find out the depreciation of the assets. Now, in this particular sum, they have given you tax rate. So, first let's find out savings. What are your savings? They've given you that savings is in terms of scrap. Savings in terms of scrap is 400 for machine A, 750 for machine B and 250 for machine C. Then saving in terms of wages is 2750 for machine A, 6000 for machine B and 2250 for machine C. Next, savings of indirect material. Indirect material is 100 rupees for machine A, nil for machine B and 250 for machine C. Therefore, your total savings is going to be equal to 2750 plus 500, that is 3250. This is 6750 This is 2250 plus 500, 2750. Right? Next, additional cost. In terms of additional cost, you have indirect material, is given to you as nil, 400 and nil. Then they've also given you additional cost of maintenance. Additional cost of maintenance is given to you as 750, 550 and 500. Then they've given you additional cost of supervision. Additional cost of supervision is given to you as nil, 800 and nil. Therefore, your total additional cost B is 750. This is going to be 8 and 4, 12, 12 and 5, 1750 and 500. Right? Then depreciation is given to you. We have already calculated depreciation as 1750, 2083 and 1800. This is the depreciation calculated, in which case I will now get, this is say ABC, I will get my profit before tax. Profit before tax, how will I get profit before tax? A minus B minus C. That is 3250 minus 750 minus 1750, which will give you 750. Similarly, 6750 minus 1750 minus 2083 is going to give you 2917. Similarly, 2750 minus 500 minus 1800 is going to give you 450. Once I have PBT, profit before tax less tax, tax is given to you at the rate of 40%. So 40% of 750 is going to be 300. 40% of 2917 will be 1167. And 40% of 450 is going to be 180. So this will give you PAT, profit after tax. Profit after tax is going to be 450. How did I get this, guys? I just subtracted these two figures. 450, 1750 and it is going to be 270. Once I have profit after tax, you add back depreciation to this. Add depreciation. Depreciation we had calculated as 1750, 2083 and 1800. This will give you your cash inflow. Right? When you add this will come to 2200. This will come to 3833. And this will come to 2070. Right? Once you have this cash inflow, leave this here. This is your second point. Next, payback period. Payback period is nothing but original investment divided by cash inflow. Right? Original investment here is 17,500 divided by 2,200. In the second case, it is 12,500 divided by 3833. In the third case, it is 9,000 divided by 2070. So in the first case, my payback period will be 7.9 years. In the second case, it will be 3.2 years. And in the third case, it will be 4.3 years. Since the payback period is least for machinery B, therefore machinery B has to be selected. Now besides this, I have to also find out my payback profitability. Guys, payback profitability is given by the formula cash inflow into estimated life minus payback period plus scrap. Now in this particular sum there is no scrap value of machinery. So for machinery A, cash inflow is 2200 into life of the machinery is 10 years, payback period is 7.9 years. So this is going to be 2200 into 2.1. Someone will have to get me this answer, guys. 2200 into 2.1. 4620. So the payback profitability of machine A is 4620. For machine B, my cash inflow is 3833. Life of the asset is 6 years. 3833. Life of the asset is 6 years. Payback period is 3.2 years. So this will be 3833 into 4, 5, 6, 2.8, 3833 into 2.8.
10732.
10732. That's a nice machine. Next, in the case of machine C, my payback period is 2070. Life of the asset is 5 years. Payback period is 4.3 years. So this is 2070 into 0.7. Someone please help me calculate this.
1449.
1449. Right? The payback profitability is maximum in the case of machinery B. The payback period is minimum in the case of machinery B. Conclusion, hence machinery B is to be selected. Do we understand this? Right? Let's see another sum of this kind, guys. We are doing question number 6. Question 6, page 284. They have given you two machineries exactly like the previous sum. First thing, now in this particular sum, since the tax rate is not given to you, therefore instead of using the fourth formula, you will be using the first formula. Fine. So let's start savings. Let us see what are the savings here. There are two machinery, machine P and machine Q. Okay. They have given you savings in scrap is 500 and 800. Then you have savings in direct wages. Savings in direct wages are 6,000 and 8,000. Fine. Therefore, your total savings are 6,500 and 8,800. Next, additional cost. The additional cost is given to you of maintenance. Additional cost of maintenance is 800 rupees and 1000 rupees. Additional cost of supervision is 1200 rupees and 1800 rupees. So my additional cost is going to be 2000 and 2800. Once I have this, then I can find out my cash inflow. Cash inflow, this is going to be nothing but A minus B. So this is 4,500 and 6,000. Right? Once you have your cash inflow, then you can find out your payback period. Your payback period is given by the formula original investment divided by cash inflow Original investment. The cost of machine P is given to you as 9,000. Payback period is cash inflow is 4,500. So payback period will be 2 years. Good machine. Next, in the case of machine B, the original investment is given to you as 18,000 rupees. Payback period is cash inflow is 6,000. So payback period will be 3 years. Since the payback period of machine P is less than that of machine Q, therefore machine P will be selected. Fine, do we get this thing clear? Next. Let's see this for question number 43. Let's see one more question of this kind. I'm doing question number 43, page 327. Right? Now, they've given you 3 machines and they've given you the tax rate also. That means you will have to use the 4th formula. Now in this particular sum, they have given you that yearly profit before tax and depreciation. So they have given you net profit before tax and depreciation. First thing that you will have to do is calculate depreciation. They have given you 3 machines, machine 1, machine 2 and machine 3, right? The cost of the machinery is 1,85,000. I'll write the formula if you want. Depreciation is cost minus scrap upon estimated life. Okay, the cost of machine is 1,85,000. Scrap value is 5,000. Life of the asset is given to you as 8 years. So this is going to be 1,80,000 divided by 8 years, which should be 22,500. Right? In the case of machine B, the cost of the asset is given to you as 1,76,000 minus scrap value is given to you as 8,000 divided by life of the asset is given to you as 12 years. So 176. So this is going to be 168. 168 divided by 12 should give you 14,000. Fine. Let's see machinery 3. Machinery 3, the cost of the asset is given to you as 2,25,000 minus scrap value is given to you as 15,000 divided by life of the asset is 10 years. So this is 2,10,000 divided by 10, that is going to be 21,000. So first thing we did was we found out the depreciation of the 3 machines. Next, they've given you net profit before tax and depreciation. Right? Net profit before tax and depreciation for machine 1 is given to you as 45,000. For machine 2 is 40,000. And for machine 3 is 55,000. Okay? Less depreciation, that's 22,500. We just calculated 14,000 and 21,000. This will give you your net, this will give you your profit before tax, right? So when you deduct 45,000 minus 22,500, you will get 22,500. 40,000 minus 14,000 should give you 26,000. 55,000 minus 21,000 should give you 34,000. Right? Less tax. Now, what is the tax rate given to you guys? The tax rate is given to you as 30%. At the rate of 30%. So you have to calculate your tax on your PBT. So tax at the rate of 30% on 22,500 will be 6,750. On 26,000 will be 7,800. On 34,000 will be 10,200. Once I have this, then I will get my PAT, profit after tax. 22,500 minus 6750 is 15,750. 26,000 minus 7,800 is 18,200. 34,000 minus 10,200 is 23,800. Once I have my profit after tax, add depreciation. Depreciation is 22,500, 14,000 and 21,000. This is going to give me my cash inflow. Right? So this is going to be 15,750 plus 22,000 is 38,250. 18,200 plus 14,000 is going to be nothing but 32,200. 23,800 plus 21,000 is 44,800. Right? Once I have my cash inflow, then I can find out my payback period. Payback period is given by the formula original investment divided by cash inflow. Right? So your original investment in the case of machine A is 1,85,000 divided by cash inflow 38,250. In the case of machinery B, it is 1,76,000 divided by 32,200. In the case of machinery C, it is 2,25,000 divided by 44,800. So for machine A, your payback period is going to be 4.83 years. For machinery B, your payback period will be 5.46 years. For machinery C, your payback period will be 5.02 years. Since the payback period is minimum for machinery 1, therefore machinery 1 should be selected. Now, let us also find out the payback profitability. Payback profitability is given by the formula cash inflow into estimated life minus payback period plus scrap. Right? For machinery A, cash inflow is 38,250 into estimated life. Estimated life is 8 years. Right? Payback period is 4.83 years plus scrap. Scrap value is given to you as 5,000. Similarly, for machinery B, cash inflow is 32,200. Estimated life is 12 years minus 5.46 years plus scrap value is 8,000. In case of machinery C, cash inflow is 44,800 into estimated life is 10 years, payback period is 5.02 years plus scrap. Scrap is 15,000. So someone will have to get me this. My payback profitability here is going to be 38,250 into, this is 7, this is 9, so 1, so this becomes 5. 3.17 plus 5,000. Someone please do this. 38,250 into 3.17 plus 38,250 into 3.17 plus 5,000. I presume it should come to 1,26,000. 1,26,252. Leave the decimal out, right? We will just write this plus 5,000 here. Okay. Now, in the case of machinery B, it is 32,200 into 4 9 minus 5, 4. This is 6.54 plus 8,000. Right? I presume this should come to somewhere close to 2,18,588. 2,18,588. Last one, 44,800 into, this is 894 plus 15,000, right? Which should come out approximately 2,38,000 something. 104. Right? Now, again, let's see this payback problem. Now, this sum has a controversy, guys. Look at this. If I go strictly by the payback period, then I should be selecting machine 1 because I will be able to recover my cost in 4.83 years. But if I am looking for profitability, maximum profitability is in machine 2. So in that case, not machine 2, sorry, machine 3. Machine 3 has maximum profitability. It is giving me a profit of post payback profit of 2,38,104. So in that case, machine C should be selected. Conclusion: on the basis of payback period, machine 1 should be selected. On the basis of payback profitability, machine 3 should be selected. This finishes this sum. We will stop here for the day. Thank you very much.